Good morning, everyone. This is Andy Gunderson with Western Marketing. I'd like to thank everyone for taking time out of their busy day to join us on this webinar with a longtime partner and friends at Equitrust. Jason Goodrich is going to be giving us Equitrust product portfolio for their life and annuity products. Just a couple housekeeping notes. If you do have questions, please try to type them in the question box, and we'll go over them after the end of the webinar. Also, you can reach any of us marketers at Western Marketing at 800-852-7152. My email address is Andy, A-N-D-Y, at WMAcorp.com. So without further ado, Jason, I do believe we're ready to go here. Let's see. I got the presenter over to you. And all right, go ahead, Jason. Take her away.
Alrighty, thanks, Andy. Appreciate it. Good morning, everyone. First off, let me just thank everyone for taking time today to join this webinar, which will focus on the annuity and life portfolio, but mainly going to focus on the 4 index annuities with Equitrust, as well as the 2 simplified issue single premium life products. Obviously, we've been in and continue to be in some unprecedented times, so I really do appreciate you joining me this morning. What I plan to do for this webinar is talk about the 2 new indices we launched first last year. About a year ago, we launched 2 new indices, so I want to get into that a little bit and show you the advantages to them, not only in this environment, but in any environment moving forward. Obviously, I believe we have some great fixed index annuity products, but the addition of these strategies has really helped in the long-term accumulation of the products. I'll also walk through the annuity products at a pretty high level, pointing out some niches we have with each one, especially in the current environment. Then I'm going to take a little bit of time and talk about the 2 single premium life products that we offer. Single premium life is an area where we've been a leader for many years, and I think you'll see why as we walk through the products and the positioning. So we have a lot to cover today, but I'm going to, as I said, keep it at a pretty high level so I can try to keep this presentation only 30 or 35 minutes or so. And then, like Andy mentioned, we'll leave some time at the end for any questions you may have. Lastly, let me thank Andy, all the great folks at Western Marketing. They've been a friend and a great partner for Equitrust for many, many years, really since the beginning of Equitrust, and really do appreciate the relationship with them. With that, let's go ahead and get started here. Okay, I mentioned we'll talk about the 4 index annuities, and you see them in front of you there. About 2 years ago, we've reduced our portfolio from 11 index annuities down to 4 index annuities. So we really simplified things, but at the same time, we made everything more competitive. So we kind of went the opposite direction of the industry. As other carriers were adding more and more products, more and more complication in a lot of cases, we kind of reduced everything, simplified it, but also made ourselves more competitive. So simple is a great thing, but you got to be competitive, and we are very competitive. So when you look at the Equitrust, the 4 index annuities, I think there's really kind of 3 main niches that we have, and I'll point those out real quick. First off would be premium bonuses. So we have 2 products that offer an upfront premium bonus. With our premium bonuses, they are what I just said, they're upfront, so there's no vesting schedule, no recapture, anything like that. The bonus is immediately part of the account value. One of them is a market power bonus, which has a 10% premium bonus up front on a 14-year chassis, and the other one's the market 10 bonus with a 6-year bonus on a 10-year chassis. And we'll get a little more into these products in a little bit. Kind of the second niche we have is accumulation. We have 2 products that are really built for maximum growth potential over the long term. One of them is a market value, which is a 10-year contract. The other is a market 7-year contract. Then the third niche we have, I think it's kind of a separator for us, is with a return of premium product. So our market 10 bonus, which has the 6% bonus, also has a free return of premium guarantee built within the product, which just means they can get their money back at any time. So those are kind of the 3 big niches we have. Premium bonuses, number 1. Number 2 would be accumulation over the long term. And number 3, return of premium guarantee. Before we get more into the products, I do want to talk about the 2 newish indices that we added. About 10 or 11 months ago, we added these to our products. The first one is the Barclays Focus 50. Now, this is exclusive to Equitrust. So you're only going to find this index on the Equitrust products, and it's currently on all 4 of our index annuities. It's a very simple indice, I think. It really just uses 3 things. So it allocates among the 50 lowest volatility stocks, U.S. Treasuries, and then cash. And when you look at the 50 lowest volatility stocks, you're typically looking at what I call the big, boring companies, which I think are very attractive now. So you're not going to see Tesla in the 50 lowest vol stocks, or you're not going to see Twitter in there or something like that. What you're going to see is companies like Coca-Cola, like Johnson & Johnson, like Dollar General, like Costco, like Walmart, like Pepsi, like Waste Management. So kind of the big boring companies that have been around a long time, have been very stable. I think that's very attractive in this index, in the time we find ourselves in. So it just uses those. And then for the treasuries, it just uses a 2-year, a 5-year, a 10-year, and a 30-year treasury option. So really just allocating between those two and using cash to balance it out. Okay, so very easy to follow, very easy to understand, and it's performed very well. The other one is called the S&P Mark V. Now this one is not exclusive to Equitrust, so you may have heard this. It's on. I know a couple other carriers have this on their index annuities as well. It is also very simple to understand, and I mentioned first, it's only on 2 of our index annuities. So the Barclays that I just talked about was on all 4. This one's only on the market value and the market 7. But the way it works is it just has 4 different areas where it allocates: equities, commodities, and fixed income. So for the equities, it uses the S&P 500, which obviously is very known. For commodities, it uses gold. And if you're not aware, gold is a great hedge against inflation. That's why that's in there. And then for the fixed income, it uses the 10-year treasury, which is very well known. And then it has a 5% risk control on it. So it just does a daily rebalance, maintaining that 5% volatility between these 3 and then cash. Once again, it's been around a while. It's very simple to understand. I'll talk a little more about kind of how it's performed, but it's performed very well. Speaking of that, this is kind of what this chart shows. Is kind of how these 2 vol control indices I just talked about have performed against the S&P 500 since the coronavirus outbreak began in February of last year. So you can see that purplish line, a lot of volatility up and down, smooths out for a while, gets more up and down, more up and down. Where you look at the other 2 lines, which represent the Barclays and the Mark V, you see how steady they stay through all the volatility. That's really the benefit to using a vol control index, I think, is the stability of it. Maybe you don't put all the clients' money in there, but it's a good way to diversify within their portfolio, within the index annuity. Here's kind of the returns on them. Now these are raw returns, right? So we're just comparing the S&P 500 raw return versus the Focus 50 raw return versus the Mark V raw return going back to 2004. If you come down here, you look at the annualized return over those, 15, 16 years, you can see the S&P annualized return during that time was 6.89, the Barclays was 5.79, and the Mark V was 5.17. However, these are raw returns. Okay, so we are not taking into account participation rates or anything like that. Okay, these are just, this is just how it would have returned without participation rates. As you probably know, any strategy on the S&P 500 is going to have a pretty low participation rate right now. I think with Equitrust, our best par rate on the S&P is 28%. So you'd have to factor a 28% par on this, which is going to make this a lot lower. Where the Barclays and Mark V are approaching 100% participation rates on some products. So these returns are more accurate. Okay, so if you factor par rates in, both of these would have performed better on an annualized basis over the S&P. Not saying we shouldn't use the S&P. I like the idea of diversifying between all of them. And then I need to update this. So this is just through the end of the year. You can see the raw returns was 2.71 for the Barclays, 7.78 for the Mark V, and then 15% for the S&P. But keep in mind that's not applying participation rates again. Okay, what this is just showing is what the current participation rates are on all the products for the Barclays 1 year, Barclays 2 year, then the Mark V. These are our current par rates, and these are the illustrated rates. Okay, so you can see, and the last 10 is what is used when you run an illustration with Equitrust. So what you can see is we're illustrating as high as 7.57 is our highest illustrated rate on our market value product. So ranging from 2.5 to 7.57, depending on what strategy and what product. Okay, let's get into the products a little more in depth. First one is the Market Power Bonus. Now, the Market Power Bonus is the very first index annuity Equitrust rolled out. We rolled it out at the end of January of 2004. And since that time, it's been our #1 selling product every year except for 1 year. All right, so it's kind of the flagship product for Equitrust. Single premium product has either a 14-year or 10-year design depending on the state you live in. And I'll show you a map in a second so you know which version you have. Like I said, it has a 10% upfront premium bonus. Once again, no vesting. So if they put $100,000 in, they immediately have $110,000. If they were to pass away a month later, the beneficiary would be guaranteed to get that $110,000. Right? There's no recapture or anything like that. Where it's appropriate, obviously, and I'll talk more about this, but early accumulation. You know, when you choose a bonus product, typically that's going to be somebody that for one reason or another wants to see their account value grow in the early years more than in the later years. Okay, if you're looking for really more later year growth, that's where a non-bonus product, you know, maybe makes more sense. Obviously, this can be used as a way to offset a loss in a low interest rate environment. You know, if caps and rates are really low, which they kind of are right now, maybe it makes sense to front load that contract a little bit. Here's the map I mentioned. So this shows the gray states here. It's not approved in. So we're really not in here like 3 states. But if you look at the dark green, I guess that is where you see my highlighter. That color of the states like Iowa, it's a 14-year contract. Okay. The states where it's a lighter color like Texas, it's a 10-year contract. So depending on your state, it's either 10 years for there or 14 years for there. Other than that, the product for the client is the same. They get the 10% bonus and everything in either of these states, and it's completely upfront. Here's the current rates. I'm not going to walk through all of these, but they are a little lower than what you'll see on our accumulation products. Once again, that's because of the premium bonus. If we go down here, they'll look at the Barclays Focus 50. You can see we have a 30% par on the 1 year and a 50% par on a 2 year. So you're looking at an illustrated rate of about 4.04% on this if you were to run an illustration. One thing I want to point out too is when you use the Barclays Focus 50 strategy, we have a fixed option budget on it. What that means is you should never see these rates change at renewal for the client. So the 30% par and the 50% par should stay steady for the most part throughout the life of the contract. They could fluctuate a little bit, but it should not be much, especially not for a few years. Okay, because our option costs do not change during that time. So that's important to note too. I should mention too, you can see it says rates if income rider not selected. Due to time constraints and stuff, this presentation is only focusing on non-income rider business. Obviously call us, call Andy if you have questions about our income riders, but we're really just kind of focusing on non-income rider for today. Okay, so that's the current rates. I mentioned a little bit ago, bonus versus non-bonus. When does it make sense? I think one time a bonus makes sense is if the client has a short time horizon before accessing penalty-free funds, right? Maybe they're going to use this as a wealth transfer vehicle because they're uninsurable. They can't get life insurance. Well, with a 10% bonus, this could make sense for a client, right? To get that immediate bonus if they're just going to leave the money to their kids or grandkids. Second thing is annuitization. You can do a 5x10 annuitization on this product on the market power bonus. So, or, you know, maybe you're doing some sort of laddering strategy or something too. Makes sense because in the first 5 years, you're probably going to see more growth in a bonus product than a non-bonus product. Then, of course, income rider is going to be helped with an early bump in the account value. Another situation I know a lot of advisors are using is the 10% penalty-free feature. Because the accumulation value is higher in the early years, the 10% free is going to be higher in the early years. So maybe you're using the free withdrawal as a bridge to Social Security for the client. If that's the case, then it could make sense to use this. It's going to get them more money in those early years from a free withdrawal perspective. Recover from an underperforming product. Maybe they're just in a product that has not performed very well. Does not perform how it was illustrated, and the client just wants to get out of it and would like to recoup some of that non-earnings they've gotten over the last few years. It's a way to do that, obviously. Low index performance. You know, it doesn't matter how high your cap is on a product or an index if the market doesn't return anything. So if the client has a 10% cap and the market returns 0, they still get 0, obviously, right? So the higher rates of caps really are dependent on performance, where the bonus is guaranteed and automatic. And lastly, I'd say is low interest rate environments where we kind of find ourselves in now with lower caps, lower rates. You know, could make sense for some clients based off that to kind of front load the contract with a premium bonus up front. Okay, that's the market power bonus. Here's our other bonus product, the Market 10 bonus. Talk a little bit about it. First off, it's flexible premium. It is a 10-year product in every state it's approved. It gives a 6% premium bonus on any premium out of the first 5 years. Okay, and there is no rolling surrender charge on that or anything. So if they add money in the 5th year, it's going to be a 6% bonus, and then only have 5 years left of surrender charge on it. Big feature with this is the return of premium rider at issue, no fee. Okay, so it's just built into the contract. So everybody that gets issued a Market 10 bonus has a day one return of premium guarantee. What that means is if something changes down the road, 3 months later, and they need their money back, they're guaranteed to get their money back at any time. Okay, 100,000 in, 100,000 out. Who's it appropriate for? Well, obviously, I say a couple big areas of this one is, number one is the peace of mind with the return of premium. As kind of the COVID stuff hit last summer, we saw a big spike in sales in this product. I think it was because of the guarantee. It's kind of knowing that they can get their money back if they need to. This is also a great product to pivot to, I think, if maybe the client has an objection to surrender charges or for some reason can't get past the surrender charge on the contract. This is a product to be pivoted to because they don't have to worry about that because they can always get their money back. Another thing is if they're trying to consolidate, maybe they're consolidating CDs. Maybe they have 4 or 5 different CDs scattered around coming due at different times. Because of the 6% bonus for the first 5 years, they can move each of them over as they come due. And at the end of the day, they got a 6% bonus on all that money. They're in an index annuity with more growth potential, and now they only have one policy. And last is Roth conversions. I do see a lot of people. I have a couple of big groups that use this as a vehicle for Roth conversions. Maybe they have an IRA sitting in a different carrier, and they just send over maybe 10% a year to us. We convert it on the fly to a Roth, then we issue the policy. The next year they do the same thing as an additional premium into that Roth. We'll convert it to Roth, add it to the existing Market 10 bonus. So it's a way to do it without doing partial conversions and creating new policies everywhere, is to do a 10% free withdrawal each year, send it over, do a conversion, and then at the end of the day, you only have one policy. It's a little more complex. I'm happy to discuss that further, though, if anybody has any questions. Okay, the rates on the Market 10, once again, they're going to be lower because of the bonus and because of the return of premium. Even though there's no cost to the outward cost of the client, obviously there's a pricing impact up to that. But once again, you got 30% and 50% on the Focus 50 here for the participation rates, and should stay steady. So from an illustration perspective, you're looking at 3.72%, it looks like, if you ran an illustration annualized return. Okay, product number 3. Those are the 2 bonus products. Now let's talk about the accumulation products. The one I'm going to talk about first is the Market Value Index. This actually was the second ever product we rolled out. This has been our biggest product really over the last year. I mentioned a little bit ago, the Market Power has been our number 1 product every year except for 1 year, and it was our number 1 product last year. But for the last 6 months of the last year, the Market Value is our number 1 product. And so far this year, the Market Value is our top product, and it's because of the long-term accumulation potential on this product and history of this product. It is a very clean, simple, plain Jane product. Not a lot to explaining it. It's a 10-year index annuity, no premium bonus, issues to age 80. It is flexible premium, but everything is put right here. It's put into the strong rates and caps, right? So we make it as simple as we can and try to give the most long-term growth potential we can. So with that, let's look at them. So here are the current caps and rates on the Market Value. You see the point-to-point cap's 425, which is very competitive right now, 28 par on the participation. You get down here to the Focus 50, you can see we have an 80% participation rate, which works out to 568 illustrated rate. On the 2-year, we have 105% participation rate, which works out to 757 illustrated rate. Then this product, we also have the Mark 5 on with a 95% par, which is a 5.66 illustrated rate. Right, so a lot of growth potential on this. And one thing I point out about this product too is we do not subsidize. We do not subsidize any of our products, but we don't subsidize at all. So all these strategies are really very competitive. And I think that's important, especially when you're looking at long-term accumulation, that you have a product that has multiple strategies that have really good rates and caps on them. Because what that's going to do is it's going to give you options at renewal to move the money around a little bit. Right. I know there's products out there that maybe have one really strong rate. The problem with that is what if, number one, what if it doesn't perform? You're kind of stuck with that one cap or one rate or one index. And number two is, what if things change? What if it did perform, but it quit performing? You have no other option to go to. So I think it's important to have the ability to diversify between a lot of different strategies, and this is kind of our top product for that. And speaking of, not subsidizing, another thing I think is really important with accumulation, long-term accumulation products is renewal rate integrity. At Equitrust, we have really strong renewal rate history. We take a lot of pride in our renewal rates. We publish all of our renewal rates on our website. So we don't cherry pick one or anything like that. Any index annuity that's ever been issued with Equitrust has renewal rate history on our website that you can go look at. You can look at what it was issued at, what it renewed at every year. And I think that's important, the transparency of that. This is just a little marketing piece we have. You can download it. It shows one example. But like I said, everything's out there and available to you. Okay, the last product is the Market 7. This is very similar to the market value. It's built for accumulation also. The difference is it's a 7-year contract instead of a 10-year contract. Okay, and it issues up to age 85. So this is the one index annuity that we offer up to age 85. The last kind of difference I'd say between it is it has this guaranteed accumulation value benefit of 107%. Okay, what that means is if they put in $100,000 at the end of 7 years, they're guaranteed to have $107,000. It's like a one-time look at the account value we do. So at the end of 7 years, we'll look at that account value. If it's less than $107,000 because it hasn't performed, we'll bump it up to $107,000. Basically, it works out to a 1% simple interest guarantee on it, which is nice to have, especially when we're getting a lot of money from CDs on this. Okay, but this is a nice little feature we have. But once again, really strong rates and caps. So you got a 4% point-to-point cap on the S&P. Again, here you got 75% on the 1-year Barclays, 110% on the 2-year Barclays, and then 85 on the Mark 5. So you're looking at illustrated rate as high as 7.25% with this product. Okay. Okay, so just to quickly summarize the annuities, simple products and procedures. It's kind of been our motto since day one, is to keep things as simple and as competitive as we can. Number 2 is the return of premium product. It's been a big deal in 2020, and I think will continue to be, is to have kind of that arrow in your quiver, to have a return of premium guarantee product to shift to or to pivot to when needed. True 10% bonus product, no vesting, all up front. The 2 accumulation value products with the 2 new indices, the Market Value, Market 7, have been our biggest growth products over the last year for sure. And along with that's renewal rate history. You got to have strong renewal rate history to have an accumulation story. And I didn't get into the fixed products of SPIA, but we have competitive products there too. I'll say especially with the SPIA, we do quite a bit of SPIA business. So if you do that, quote us. 5-year, 10-year, especially the period certains, we're very competitive there. Okay, that's the quick overview of the 4 index annuities. Now what I'm going to do is talk a little bit about the simplified issue single premium life insurance, which we got into that business, I believe, in late 2009, early 2010. We were a number 1 carrier in that market for quite a while. It's still an area where we're very strong and a leader in. So let's talk a little bit about that. First off, the positioning and sales opportunities. As far as product positioning, there's really 2 areas, 2 main areas where I think somebody would consider single premium life insurance with Equitrust. Number 1 is that they're looking for a wealth transfer vehicle. They had a lump sum of money sitting somewhere that they plan on leaving to the kids. This single premium life can be a very effective way to do that. The second positioning would be chronic illness. What I mean by that is maybe they don't have adequate long-term care insurance. They've not addressed that need, and they don't want to through long-term care, through traditional long-term care or long-term care rider. We'll talk about this in a minute, but our products have a chronic illness rider, which works in a similar way. And it's a way to address that need without going through all the long-term care underwriting and things like that. Okay, so those are really the 2 things. And to be honest, I'd say the sales we get are about 50-50 between the positioning being wealth transfer or chronic illness. Sales opportunities, probably 80% of the money we see come into our single premium life products comes from cash equivalents. You see my number there, 19.4 trillion sitting in a liquid position, like a savings account, checking account, money market. something like that. And that's an old number. That number's a year old. I'm sure it's way higher than that now. But 19 trillion sitting there, and 80% of our money is coming from a spot like that, and a lot of it's done in annual reviews. Okay, that's the other thing about these products. They're a great option when doing an annual review with a client if you know they have a lump sum of money sitting somewhere that they don't need, but for one reason or another have not been willing to move it. This could be a great option, and I'll talk about that in a little bit. But another sales opportunity is life insurance. I think it's easy to assume if somebody already has a life insurance policy that there's probably no use moving it to another life insurance policy because the death benefit's probably higher on the previous one. That may be true, but there's other reasons why to move it. Number one, underperforming policy. There's tons of life insurance policies out there that were over illustrated, where a client was paying premium into them of so much per year based off the illustration, but then it did not perform that well. So now they're in danger of that policy lapsing on them. So they're having to put a lot of money in there. Instead of doing that, they could take the cash value, they could 1035 exchange it to a single premium life product and get a paid up policy that they never have to pay premium into again. Second one I see are still paying premiums. I have a group here in Iowa that works with a lot of clients that they sold whole life to 20 years ago, right? So these clients are paying $80, $90, $100 a month in these whole life policies, but now they're 75 years old and they don't really need the whole life policy anymore, and they don't want to pay the $75 anymore, right? Their needs have changed compared to when they were 50 or 55 years old. So instead of continuing to pay that $80 or $100, we take that $15,000 in cash value or whatever, we 1035 it into a single premium life product. They no longer have to pay any more premiums. They may get a little less death benefit, but now they get the chronic illness benefits and don't have to pay any more premiums, right? So that makes sense. And then just the no chronic illness benefits. A lot of these older life policies did not have the chronic illness part of it, which is a huge thing right now, obviously. And the third opportunity is annuities. There's a lot of old annuities out there where maybe you can't move them really because of the high guarantees on them or something, but the client also doesn't need the money. Well, you can move it into single premium life insurance, right? So now I will say that's a taxable event, so you got to be prepared for that to make that move. But it's going to give if the client's goal really is wealth transfer, it's probably going to be better to pay the taxes now and move the money into the life policy to maximize what goes to their beneficiaries. Okay, underwriting process. It's simplified issue, point of sale underwriting. So as you meet with the client, you do the underwriting right then, you get the decision right then in most cases. Okay, there's only two things that impact the client. Number one, there's some health questions they have to answer. Now these are knockout questions. Okay, so they have to answer no to everything. So if they answer yes to any of the questions, they are not going to qualify for the single premium life insurance. We have a copy of that on our website. Andy can get you a copy of that. So before you go through the app process with the client, you can pre-qualify them. So assuming they answer no to everything, then you can move forward with it, and there'll be a phone interview that's done. You as the advisor initiate that phone interview, right? You hand the phone to your client after you initiate it, and then they ask the client the same health questions, and they just repeat the questions. Okay, it's probably about a 15, 20-minute interview on the phone with them. At that point, the client will hand the phone back to you, and they will give you a decision. Okay, there is no exams or fluid draws ever. Okay, no parameds at all. It's done point of sale. Now, assuming the case is under $250,000 in premium, you'll get the decision right there on the phone, yes or no, and you'll know right then. So over 90% of our cases are approved, but if it is a no, you'll know right then, and you can pivot to something else like an annuity. Now, if the case is 250 or above, we will take one additional step, and we will order an APS at Equitrust, and we'll handle that. And as soon as we get that back and reviewed, we will give you the decision. Okay, so very fast underwriting process, very simple and easy to follow. There is an instruction page, cover page on the application that you just follow step by step when you're with the client. Okay, living benefit rider. I mentioned chronic illness earlier. Now, both these products have a living benefit rider that's automatically included in the policy at no charge. In the states where it's approved, and it's approved in most states. There's a one-time charge of $250 if they elect it, but if they don't ever use it, there's never any charge to it. Okay, so there's three things that would trigger us to pay out the death benefit while they're still living. Okay, number one, if they become terminally ill. So if they have less than 12 months to live, as told by a doctor, we have we'll pay them out 95% of the death benefit in a lump sum. Okay, and that is tax-free. So whatever that death benefit is, they get 95% of it tax-free to the benefit or to the client. Second was nursing care confinement. So if they're confined to a nursing care facility for 90 consecutive days, they have the option to either get 85% of the death benefit paid to them, or what most people choose is they would choose 100% of the death benefit over a 3-year period. So whatever that death benefit is divided by 36 months, we'll pay them that much each and every month for 3 years. Okay. If they pass away before it's all paid out, the remainder is paid in a lump sum to their beneficiary. Okay, I'll walk through a sample of this in a second, but I should also mention this even though this is not long-term care insurance, it does fall within the long-term care guidelines. So assuming they meet the per diem, which they should if they're doing it monthly, right, and they use it properly and spend it properly, there should not be taxation on it. Okay. Now this is an indemnity plan too. It's not a reimbursement plan. So they don't have to send in receipts or anything. And once we get the notice from the doctor that they've been confined, or from the nursing home that they've been confined for 90 days, we start paying it. Okay, they don't have to send receipts or anything. And the third one, and the big one, is what we call chronic care or chronic illness. Now, to qualify for chronic care benefit, you do not have to be confined to a nursing home, right? This is just a loss of 2 of 6 activities of daily living for 90 days. So we get a letter from their doctor says they cannot perform 2 of 6 ADLs and it's been over 90 days. If they can't do that, then they can access the death benefit from their single premium life insurance with us. The way it works is it's 75% if they do a lump sum, but once again, most don't do a lump sum. What they do is they take 100% of that death benefit over 5 years. So if their death benefit is $100,000, you just divide that by 60 months, and that's what they get each and every month. Once again, assuming they use it properly and take it properly, it should be tax-free. Okay? And once again, that's free. Excuse me, that's automatically included with every policy we use, and there's just a one-time charge of $250 if they ever elect one of these. Okay, we'll start with the Wealth Max bonus. This is kind of a flagship life product. It was the leading simplified issue life product in the market for quite a few years. Standard features on it, issues 45 to 80, so 80 is the maximum age. Minimum premium is $10,000, maximum $750 face amount, so it depends on how old they are. I mentioned this, but these products are guaranteed death benefit, right? So they're not going to lapse at age 121. It does have a 10-year surrender schedule and does allow 5% penalty-free withdrawals per year. Kind of some additional features to it is a 5% premium bonus. So immediately they get a bonus on their account value, which immediately is going to bump up their death benefit above their face amount. Okay, so that's a nice feature. The big one with this is the return of premium guarantee. Okay, kind of like the Market 10 bonus on the annuity side had a return of premium guarantee built in, the Wealth Max bonus has one built in. Okay, that's why, and I think this is the reason right here, the return of premium guarantee. This is why these products have been so popular for clients that have liquid money. You know, we talked about that 19.4 trillion sitting in cash equivalents. That's why that type of money is attractive for this product, because they can, what I call it is just moving money from your left pocket to your right pocket, right? Let's say a client has $100,000 sitting in a savings account. Well, all they're doing is moving that money from the left pocket to the right pocket, from the savings account to the Wealth Max bonus. They're keeping everything that savings account offered them, I mean, except for the FDIC, but they're keeping the guarantee that they can get that money at any time because this has a return of premium guarantee. But what they're adding is a death benefit way more than that $100,000, tax-free access for a long-term care need, right? And they still get and growth potential that they didn't have in the savings account. So it really is kind of a reallocating the money from the savings account to the life product. Rates on it. See here, this has a few strategies. It has a point-to-point S&P cap of 7, has a monthly average on the S&P with a 70% par. Then it has the Barclays 1 year with 125% par, and the Mark 5 1 year with 140% par. So a lot higher rates than you see on the annuities. Here you kind of see the illustrated rates. What I point out about this is you can see 4.62 is the highest. That's because with life insurance, AG 49, if you've heard AG 49, it limits how you can illustrate a product, and it has to be based off the point-to-point cap. So when we calculate illustrated rates, we have to use this 7% point-to-point cap, and that's why that works up to 4.62. If we didn't have to do that, and I'll show you a sample in a second, the illustrated rates for these two would be a lot higher than the 4.62, but we're kind of limited to that because of AG 49. So what does the Wealth Max offer your clients? Well, three things, I think. Number one, guaranteed death benefit. If their goal is wealth transfer, obviously this is going to be a great option. Number two, living benefits. If they've not addressed a long-term care need or nursing home need, this is a great way to do it without going through all the long-term care process. And then number three is if their needs change, they're guaranteed to get their money back at any time. All right, let's walk through a quick case example, and then I'll show you the other product, and we'll get out of here. So scenario here, we have Carolyn, who's age 60, has $100,000 in a CD earning 2%. Her objective is just to leave this money to her two grandkids, but she does have concern about needing to access some of the money for a health-related need, like nursing home care. We'll give her three options. She can leave the money in the CD at that 2% rate, which is obviously is a great CD rate. She can transfer it to an annuity at 3%, which is a great annuity rate, or she can purchase the Wealth Max bonus policy. So let's see what happens. We're going to look at what happens if she were to pass away immediately, if she were to pass away 10 years down the road, or if she were to pass away 20 years down the road. Let's look at the CD first. So you see the CD started at 100,000. At 10 years, it'll be 116. At 20 years, it'll be 136. We're assuming a 24% tax rate here because obviously the CD is taxable every year. Now let's look at the annuity. Annuity is tax deferred, but in most cases, it's going to be a tax to death. So 100,000 immediate, 126 in 10 years, 161 in 20 years. Now let's look at the Wealth Max. The Wealth Max is immediately $195,000 guaranteed for the life. It may grow above that, but it's guaranteed to be $195,000, whether she passes away immediately or 20 years down the road. So obviously, if the goal is wealth transfer, it makes a ton of sense to move to something like this and get that return of premium guarantee so you can still get your money back. Just to put a little color to this, if she were to stay in that CD, it would take her 41 years to get to $195,000 at that 2% rate. If she were to get in the annuity at $100,000, it would take 27 years in the annuity at 3%, even growing deferred or tax deferred to get to $195,000. So a long time compared to what she could get immediately in the Wealth Max bonus. Okay, let's say she had to access the money while she was living. For terminal illness, the $100,000 guarantees her $185,000 tax-free. For nursing home, that $100,000 initial deposit guarantees her $5,400 a month for 36 months to pay for nursing care. And the $100,000 guarantees her $3,245 a month for 60 months to pay for chronic illness. These are guaranteed numbers, okay? It could be higher if her death benefits grows and gets higher, but these are guarantees. Now, this is a supplement that prints with the illustration. I like to point this out because I have a lot of agents that use this as their primary sales piece. So this is actually within the illustration you would run on the Wealth Max bonus. It's called the Power of Guarantees, and that's what this is about. This is all about guarantees. It says guarantees 9 times in this illustration, okay? And using this example we just did, what it shows is, it shows Carolyn that if she were to pass away, her beneficiaries are guaranteed to get $195,000 off that $100,000. If she needs to access it for nursing care or chronic or terminal, these are guarantees for her, what she would get, okay, for that at a minimum. And if she needs to get her money back, she's guaranteed to get that $100,000 back immediately. Well, it's a nice one-page supplement, the illustration that works more like a marketing piece, and it does a great job, I think, explaining to the client what's guaranteed in a very simple format. Now, there is another supplement that looks very similar, but instead of the Power of Guarantees, it's a life expectancy snapshot. Okay, this is Carolyn again. This is the same example of her $100,000 with a $195,000 death benefit, but instead of looking at the guarantees, it's going to look at what her values on a non-guaranteed basis look like at her life expectancy age, which for Carolyn, her life expectancy age is 88. Right, so instead of $195,000 death benefit, it's actually $240,000 based off the illustration. Okay, the nursing care instead of $5,410 is $6,685. The chronic instead of $3,246 is $4,011 monthly, and the terminal illness instead of $182 or whatever it was is $228. And the cash value is $188,000 instead of $100,000. Right. So the previous one was the guarantee, and this is the non-guarantee. Okay. Okay, and I do want to point this out too. I mentioned earlier about AG 49 that we're required to use the point-to-point cap as our top illustrated rate when running illustrations, which we do. But this is a page that prints in the illustration too, showing the annualized return of all the strategies based off the current caps right here. So you can see, going back 20 years. So you can see this is the point to point with a 7% cap. You can see the annualized return is 4.48, which is why we use that for an illustrated rate. If you look at the Barclays, you can see that actually the actual annualized return on that strategy with the current par rate is 7.32, and with the Mark 5, it's 8.35. So just something you can show the client to show, yes, we're limited to the 4.62 illustrated rate, but actually there's a lot more growth potential because of these other strategies in there that we can't use, for the illustrated rate that have proven performance. Okay, that was the Wealth Max. Lastly is the Wealth Horizon product. Very, very similar to the Wealth Max. Same issue ages, all this stuff's the same. Issue ages, premium, has a guaranteed death benefit, has a surrender charge, has free withdrawals. The big difference is this one has higher face amounts and better long-term accumulation, better rates and caps. And what the client's giving up for that is they do not get a premium bonus with the Wealth Horizon, and they do not get the return of premium guarantee. Okay, so the trade-off is no return of premium guarantee, no premium bonus. In exchange for that, you get a higher death benefit and higher growth potential with rates and caps. It also has the same strategies. Okay, so it's really, depends on what the client's looking for. To be honest, our sales are probably about 60-40. Wealth Max to Wealth Horizon, we get a lot of Wealth Horizon business just because the values are a lot higher. The death benefit's higher. You can see the rates are quite a bit higher. So instead of 7% cap, it's 9% cap on the point-to-point, 140 on the Barclays par, and 150 on the Mark 5. So instead of a 4.62 illustrated rate, it's 6.62, right? 2% higher per year return based off the illustration because they gave up the return of premium guarantee, basically. That same Carolyn example here, you can see instead of $195,000 death benefit, it's actually $208,000 for a guarantee. Instead of $54.10, it's $57.71. Okay, so it's higher here, it's $34.63. So, long story short, the potential, the guarantees and the potential growth are stronger with the Wealth Horizon, but you lose that return of premium guarantee, which is the big thing. Then the life expectancy snapshot. So this is looking at her at age 88. You can see the death benefit is 321 instead of 208, a lot higher because of the growth potential. You're looking at 8,900 for nursing care, 53 for chronic, 251,000 cash value. This is kind of the one people look at and want to go to the Wealth Horizon because these values are so much higher because they gave up the return of premium. Okay, then this is the one I showed you with the Barclays. It shows the point-to-point cap at 9 with a 5.69 annualized return. You can see 8.18 on the Barclays, and I can't quite read that, but it looks like 8.93 on the Mark 5. Okay, so just to wrap up, the two single premium life products, both of them have accelerated death benefit rider to access that money while they're still living to pay for a chronic illness or nursing care or terminal. Both have guaranteed death benefits, don't have to worry about a lapsing. You have the Underwrite Now process, which is the point of sale underwriting, get the decision when you're with the client. And then these two new indices. The difference is the Wealth Max bonus has a return of premium guarantee and a 5% premium bonus, and the Wealth Horizon has higher face amounts and higher caps. Okay, it's pretty simple. With that, it was kind of long. I tried to keep as high level as I could, but I do appreciate your time. Appreciate you joining us today, and I'll pass back off to Andy to see if there's any questions.
Thanks, Jason. Good job as always. Nope, you did an excellent job, so no questions did come in here. But anyway, just wanted to thank everybody for their time. And if you're not currently writing with Equitrust or you do not know about their quality products, please give us a call here at Western Marketing. Again, the number is 800-852-7152. So thanks again, Jason, and thanks everybody. Have a great day. Spring is just around the corner, so look forward to that. And thanks again. Take care, everybody.
Thank you.